This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, how you going? Phil Tarrant, co-host of Inside Commercial Property with Rethink Investing. Our friends at Rethink, season 3 I think we're in right now. God, I remember kicking this off during the COVID pandemic when someone had a great idea. It wasn't my great idea, that we should concentrate on commercial investing as a way to help residential property investors maybe think about property differently, change your investment strategy, do things differently. And we teamed up with our mates over at Rethink. Scott O'Neill's joining me in the studio. Founder, director, how you going?
Yeah, very good, mate.
Good.
Yep, well
enjoying
said.
this?
3 years. We're getting old.
It's horrible.
Yeah.
It's horrible. It doesn't feel that long to be honest with you.
Nah, I was shocked when I heard it was 3 years. I felt like we've only been doing this for 18
This
months.
is pretty much the start of the third season. Yeah. Should know.
And ready to do another few years. So looking forward to it.
That's the idea, and it's been pretty popular. Some people say that we are the lifeblood of commercial property in Australia. And you got to remember this, we're very much orientated, this podcast, not towards commercial property usually gets thrown into the big deals happening in commercial real estate. You pick up the Financial Review, there'll be sort of major assets like the Salesforce Tower, which now dominates the Sydney skyline, getting discussed about major office developments, major precinct developments. Where we've chosen to focus this particular podcast, Scott, is not that institutional level, it's everywhere else. So from mum and dad investors looking to diversify their portfolio to buying their first commercial investment, maybe 500 grand somewhere or other. There's not that many places these days, but you can still get 500 grand commercial properties all the way through to sort of multi-million dollar assets. But we don't sort of go much above probably 20 million, I reckon. That's only a certain part of the world that operates in that space.
Yeah, that's right. And like I do a lot of other interviews in places, and all they do is talk about, what's happening in the office space, or that big tower doing that. And everyday Australians don't really care about that because it's out of reach. You might have a touch of it in your super fund, but it's not going to change your wealth. And that's the problem with the Australian landscape. Commercial has just been thrown into the too hard basket. And that's why we set this up all those years ago. And yeah, it's like we literally get recognised in the street because of it, which is...
So people stop you and go, oh, you're Scott O'Neill.
Yeah, a little bit. It's still strange.
You get carried by that Phil Tarrant bloke the whole way through that podcast. That's what they say, don't they?
Every time, mate. Yeah. Every time. No, but it's good because we've just opened it up to the mums and dads and the individual investors because no one talks about this. And now it's becoming more popular. And I think, it was naturally going to become more popular due to the numbers and the fact that Resi's yields are so low. So the numbers will always, attract people. So we're just educating and that's been I think it's the best part of what I do. I like, if I'm going to be remembered for one thing, it's, just opening this asset class up to as many Australians as possible. And that's really enjoyable,
And if I remember correctly, and I get this graph, you must get every now and then, it sort of talks about where the asset classes in Australia, the biggest asset class in Australia is residential property, where most people hold their wealth. Trillions, $7 trillion, I think, by memory. Maybe we got that right, maybe wrong. And then after resi property, I think it's self-managed super is where the next sort of biggest aggregate of wealth in asset classes. And then I think it's retail and industry super. And then I think it's equities, the stock market. And then I think it's commercial property. I think I've got that right, or thereabouts. Maybe the order's a bit different, but commercial property as the weight of the asset class is probably about fifth in the size and scope of it, but it's still a very significant asset class for Australian.
Yeah, and that obviously contributes to the lack of knowledge people have on it. There's, it's a relatively high purchase point entry. You can get into equities for very little money and you can have a little gamble when you don't know anything into that and then learn as you go in. But commercial, it's kind of like you're in the deep end straight up. And
it's not as forgiving as making a couple of bad stock picks for a couple of grand somewhere.
Correct. Yeah. But history proves that it is, it's pretty hard to do a bad deal in commercial if you do it properly because it's still attached to property, bricks and mortar, lands, supply. It's, I've been working with some statisticians because we're releasing our updated book in the next few months. And
you can't help plugging that, can you?
No.
What's it called again?
Same name.
Same name?
Yeah,
okay.
We're just rehashing it.
2023 edition.
Yep.
Okay.
Basically 100 extra pages, and it's we talk about like the GFC, what properties did well and did terribly in that, what the effect of that was a few years after. Go back and look at COVID, what happened. Which is important because we all invest a little bit differently because of COVID, and more people are in commercial because of COVID as well.
Yeah, agree.
But I'll go into these stats in a future episode. But the growth rates since over the last 30 years for commercial, for all asset classes except one, have beaten residential in terms of annual growth rates.
Okay.
Which was mind-blowing for me because we're all brought up to tell you that residential grows more. Statistically, it's incorrect.
Well, I think what we should do then, let's put a marker on that. And once you've got the book done, send me an advanced copy. I'll have a read of it and we can do a book review.
You had the first
old school
book last time.
I did. So. Yeah. You going to sign it again? You're more famous now. I'll see you. I saw you on the, what was it on? I was looking at your social stuff the other day. Your chat with Mark Burris around commercial property. Was that around sort of big insto stuff or was that mum and dad stuff?
Oh, He started with the insto, as they all do, because everyone relates to, that tower sold at that. Talk about the office market. It's the standard topic. Everyone talks about office when you don't really talk about commercial much because you can relate to it. He delved into, because he's obviously got the lending side of things down pat. So, he understood all that stuff and asked real good questions.
He's a bright bloke. He knows what he's on about. So he would have been asking the right questions.
Good chat. Good to meet the bloke.
Yeah.
So,
that's cool. And that's it. And anyone largely that has a retail or industry super fund will probably have some exposure to commercial property. They're probably the big insto investors with big industrial blocks where you see Bunnings and Harvey Normans and stuff. A lot of that is normally owned by super funds. Some of it's owned privately. And then the big office towers are largely owned by big super funds and they like it, right? It's a steady return. They do some creative stuff in showcasing the value of the properties. That's a murky world that no one really understands properly.
Yeah, and that's one of the hardest things of trying to work out these growth rates because there's very little data from years ago, and the way we do it is look at the square metre rates because then you can cut through all the bull crap about the what yield you should cap rate it at because you can play around with yield and change the value of an asset like by huge percentages. Yeah. So it's best to look at the square metre rate if you're just going for raw capital growth, and that was a method that we applied, getting those numbers. But there's obviously a lot of headlines right now about the office market not adjusting their internal valuations to match the reality of the market. And what I'm seeing as an investor on the ground is a two-speed market because we deal with a lot of the entry-level prices that the fund managers deal with, and there's a lot of them selling right now because they look like, I don't know if they've got liquidity issues or they've got less investors going into their funds, but you're seeing them sell off a lot more assets and they're not buying from each other at the same rate. So the deals are pretty good at the moment in that range. And then once you get under that, I don't know, call it 10 mil, it's still extremely competitive because all the individual investors...
They start coming in, sort of good sort of family office money, sort of, It's interesting. And the office market is where most people sort of frame commercial purchasing. I'd sort of note, I think Elon Musk with Twitter just went, no, I'm not paying the rent anymore on his commercial properties. His commercial space went, no, it's overpriced anyway. I'm not paying, you get stuffed. And they just went, oh, okay, no worries.
Yeah.
So,
didn't you get rid of 80% of the workforce too? Solid.
Just went stuff it, there you go. But anyway, I've been looking for today's chat because there's something happening in Australia. It's been happening for many, many, many years, for generations. And this is the inherent perpetual transitioning of real estate assets from generations to generations, and particularly I'm talking about rural communities and rural families. And we're joined today by someone that knocks around a fair bit in this space. He's a rural property strategist at Rethink Investing, Michael McIntosh. And I really want to get into this because rural or otherwise, it's this transition of generational wealth, which is great if you've got it. I know a lot of property investors are looking to build it. You must see that a lot in your client base. They go, why are you investing in property? Oh, because I want to build something for the next generation. So there's still perpetually people trying to create this notion of generational wealth and helping the generations subsequent to them. But where we are at a sort of rural level, you've got a lot of Aussie farmers, a lot of rural Australians have seen huge spikes in the value of their assets over the last period of time, but there's still sort of don't have a lot of dough to keep businesses running, whether it's farming or other agricultural assets or agricultural ventures. So we want to get into this today, and this is from the horse's mouth. Michael's from a place called Gundawindi, which I sort of thought I knew where it was, and I was pretty right. But if you go west of, sort of southwest of Brisbane and keep driving for probably a couple of 100 kilometres towards New South Wales border, you find this little town called Gundawindi, right on the border there on the McIntosh River. And that's where he's from. And it sounds like that's where he was brought up as well. How is Gundawindi these days? Have you got the internet out there yet, Michael? Welcome to the show.
Thanks, mate. Thank you. No, Gundawindi's great. It's one of the better towns. It's I don't know how many. We'd have 6,000 or 7,000 people probably.
Yeah.
It's a strong agricultural region, supports industries, cotton, wheat, cattle. So it's sort of a hub for a big area for West. It's about 4.5 hours west of Brisbane, as you said, right on the Queensland-New South Wales border. So it's on the Newell Highway, which is a main inland route from Melbourne north.
Is that near the Stanhope Ranges? Is that near there? No. Don't know. Gundawindi. People in Gundawindi just care about Gundawindi. How big is Gundawindi?
6,000 or 7,000 people, I'd say.
Okay, so it's a decent sort of town.
Yeah.
How many pubs in Gundawindi?
3 or 4.
Okay. What's the best one?
They're all good.
Yeah?
They're all good. I don't want to put any publicans offside.
No. Well, it's what are the real estate agents like in Gundawindi?
Great.
They know what they're doing.
They're good,
yeah. No. So you're with Rethink Investing, and you sort of focus on rural property, sort of helping Australians generational wealth, sort of transition that wealth through property. You must have seen substantial changes over the last couple of years, Michael, in terms of asset values of farmland and agricultural land versus how much cash farmers have, right? They have great years, farmers, but often they have less than great years, and they always seem like to be crying poor. Farmers always crying poor.
No, well, it's a difficult industry to be in. Obviously, they're competing with not only world markets that aren't necessarily fair. We're a long way from anywhere. We've got a difficult weather pattern to deal with. So, we're a dry continent. Australian farmers are very good at being at the forefront of technologies, emerging technologies, of adopting new ones. They're very efficient, so willing to look at a lot of different things. I think to be a farmer in Australia, you need to be quite tolerant of risk. I think farmers are no different to everyone else. They accept risk as long as they understand it. And, a lot of the strategies are about conserving moisture, minimising risk, managing markets as they can. So, Australian farmers are a very efficient group that I would have thought are at the forefront of world agriculture.
Yep, I completely agree with that. And I think a lot of people actually forget, there's this notion of Australia was built on the sheep's back, right? It's been very much the tempo and the heartbeat of the nation for many years. And it's like we've sort of forgotten about the value that farmers provide, but it's still a huge economic driver and a huge economic engine. And farming just isn't, livestock or cotton or sugarcane or whatever. It's all the other stuff. It's fish farming, it's lobster farming, it's viticulture. Everything is interconnected.
Exactly. And you mentioned before about asset values. There's been this huge influx of money, I guess. I think Australia was seen as quite cheap for land in a worldwide sense. So there seemed to be this, there's all these overseas super funds that got all this money they're desperate to put somewhere. And over the last 10 years, I've seen this huge increase in the value of farming land in Australia. And so farmers, their everyday cash flow hasn't improved a whole lot, but they've had this huge increase in equity, which, has allowed them to purchase more land, to expand. I mean, one of the things that's very important in agriculture in Australia is scale. So, if economy of scale, but scale generally, you need to be efficient, and to do that, there's certain levels you need to get at. And I think generally farms have got bigger because they've needed to, but there's not necessarily a lot more cash in the system. So, when you talk about creating generational wealth, a lot of these are farming families that have done it for a couple of generations. The difficulty is, how do I transition to the next one? So there's the parents that we need to consider. So mum and dad, when they want to retire, how do they get out? They may not have been able to necessarily put a lot of money aside during the period, because there's always this sort of this pull, do you invest in the new new planter that's going to help next year's crop, or the new something that's going to help efficiencies that'll have immediate effect, or there's this long-term sort of issue that we all know is there that has to be addressed one day, but, are there funds available to do that? And then there's the non-farming members of the family, i.e. kids that may want to come home. Some may, some mightn't. How do you try and create some equity amongst all that? So, we think that commercial property is the ideal tool because you've got a cash flow positive asset. You can sit outside the business. It will pay itself off without the farm having to contribute. Really, all it's going to tie up in the initial stages is some equity, which potentially is not being utilised anyway. And, if they use 100% equity and no cash, it might take 20 years to pay that thing off. But, time's your friend. That's great. And, if they were to put in, say, $5 million worth of equity, they could potentially leverage that up to 12 or 15 million. And by the time 20 years comes down the track, that's fully paid off with a very significant cash flow coming in. And what that provides is choices. So, people have always wanted to have an equitable and a fair and successful transfer of generational assets, i.e. succession plan. But, they're dealing with what they've got at the time, and often that is a lack of funds, which makes it difficult. And so if this thing can be just ticking away out to one side and over time looking after itself, it's increasing in value through just, at the very least, through increase in rents over time, by the time these decisions have to be made and, there's more choice because there's more funds available, this thing, and you might get one that, you get it half paid off and then use the equity in that to buy another one. So, it can be this whole thing, which is in the first stage is just a simple diversification. It's a risk or a drought mitigation tool. It's a stable flow of flexible source of income out to one side. I mean, if you need it, you just pause principal repayments and just use the cash flow. It's got all this sort of flexibility about it. And, if it's purchased in the right entity, it provides huge amount of flexibility down the track. And, as you know, time erodes the value of money. So, if people, for instance, get to a stage in their life where they sell the business and no one wants to take it over, the worst thing can happen is that, they put that money in the bank and find that, every year it's becoming less and less. We would certainly advocate that there's a case for investing in something like commercial property where it's going to at least keep up with the value of money.
So there's a lot of moving parts when you sort of explain it like that. And this is the challenge that farmers have and rural communities in general is there is so much uncertainty. You need to have an appetite for risk to be a farmer, and there is so much outside of your control. It's probably one of those industry sectors there's more outside of your control than other areas. You don't know what the weather's going to do. You don't know what's coming over the horizon the next day, right? And that's tough, and it's tough for farmers, and a lot of farmers struggle with that dichotomy. It's got to get it right. You've got to get the sequence right. You've got to make the right investment decisions in terms of planning equipment and capabilities for next year's crop. This is a perpetual issue. I don't know if you guys you've probably seen Clarkson's farm in the UK. They reckon that's been one of the greatest enablers for farming in the UK, and I think generally because people now have a real appreciation of how tough a gig it is to get right. If you get it right, brilliant, but most of the time it seems to go wrong. So what you're talking about is de-risking it. So how do you use the value, the equity you have in the land that you have to actually diversify? So the question is, how soon do you do that as part of a journey? Because, if you're thinking about if you've got 4 kids, 2 of them might want to be in farming, 2 of them might not want to be in farming. They're going to want their lick of the ice cream of the family assets. So you can start building that outside of it independently for that preparation time. It sounds like smart business. Yeah,
well, I think it's like all investment strategies. The earlier you start, the better. It's difficult to think about better retirement when you're, just getting married.
Yeah.
But that is the perfect time to be starting. For one, as I said, it's just a risk mitigation tool for your business, so that never hurts. But it gives it time to develop, and it gives it time for it to poke away because, this is no different to all other aspects of business. A good business strategy is sometimes just a very boring, slow burn. And that's what this can be if you have time. So you just buy a really good blue chip asset in the right location, maybe a good industrial property or something like that, and it will just tick away to the side. You get a great property manager. So, you'll have to have no input in it really. But, over time it pays itself off and there is a growth strategy attached. As I said, that you get it paid down and you can utilise the equity in that property to purchase another one. So, and at the same time, if you put your money outside the farm early and you're very proactive with these sort of things, it's got to be into a tool that will potentially be able to have some equity in the value by the time it comes to retirement. Yeah. So it has to be a strategy where it's got growth similar to the farming land. I mean, they will grow in different rates. One might be better than the other, but at least there's potential for it to be equitable when the time comes.
Yeah, and there's so many options. There's so many ways you can slice and dice. And this is why succession, particularly in rural families, rural communities, is so important. You get some really smart accounts that specialise in this stuff. But sort of diversifying your ability to generate income outside of the manufacturing of whatever the farming activity you're doing it makes a lot of sense. I guess the question is if you have a rural asset and you're thinking about succession, and one of the options might be you live off the income that a commercial property or commercial properties generates as the retiring parents and you pass on the asset of the farming completely to new generations. That's one way it can work out. But how do you make the initial start? If you've got, let's say, a reasonable farming operation, but it's not sort of knocking the lights out, you just sort of, you're making, a lot of people just break even in farming, right? But you have such a strong asset value in the property. How do you get some money out of that in order to park it to create a deposit for commercial property? Because rural lending is a completely beast in itself. They're happy to sort of to give you finance for equipment and other sort of farming machinery, but to actually refinance your home, your property to get some money out of it, how difficult is that?
No, it should be a pretty simple process. Any loan based on real assets like property, and that's all that a farm is a huge chunk of property, it's perfect to borrow against. And, in terms of the cash flow, it's like everything. You need to, doesn't matter what business you're in, you got to understand, what the game is. And really the way you're going to make money out of all property, including rural, over the long term is really capital gain. And so the sooner you start, the sooner you get money outside it. To start is as simple as having a discussion with your accountant, with us, and we can talk through the different asset classes. So, for instance, farmers have a huge amount of autonomy over their land. They don't need to have a committee to decide things, so they would be more interested in, say, freestanding assets, maybe an industrial asset, something like that. The sort of tenants in those sort of assets would be ones that they would get on well with. I think farmers are good with relationships. They understand that all property, and this would be no different, is a long-term strategy. So they're very well aligned to investing in commercial property. I mean, I think often they're no different to anyone else. They may have a unit at the coast, or they might have bought a house somewhere, and they're a bit unenthused because it's cash flow nothing. They potentially just got it out to the side for the sake of having it. There's not necessarily a great strategy attached. So I think if we could, and that's all we're trying to do, is just expose them to the idea that there's this commercial property thing out there that can sit there, can pay itself off. It's got this huge attractive thing called positive cash flow that can pay itself off without you contributing over time. And the other aspect that is so important with commercial property, people think when they've signed a contract that they've bought a property. They haven't. All they've done is secured a due diligence period. And so they've got this ability to really consider the property thoughtfully, have more discussions with their advisors as to how it might fit into a longer term strategy, get all the nuts and bolts of this property before they decide. So by the time they've decided and they're actually committing money to it, it can be a really considered, thoughtful investment that fits into an overall strategy, and we can help with those strategies. And sometimes it's as simple as mum and dad or the family sitting down, and they might say, "Look, mum and dad are 55 now. Is it too late?" Well, it's not, because depending on your stage in life and what you're trying to get out of the investment, you may be just looking for a cash flow. So in that case, let's just find a good property that returns 7%, something like that. Still a great property. They're not necessarily worried about paying the property off. they're just going to live off the cash flow. And when that stops for whatever reason, then the kids can, take over and start paying it down. So it's sort of, or, it's going to serve that purpose of helping the parents exit the business.
Yeah.
But secondly, it's in place for the next generation to take it over, pay it down and use it for a longer term strategy. And we say that all the time. Some people will say, look, I'm 60 and really we're looking at retiring and we just want to travel around Australia. Great, let's just find a good cash flow positive property that's going to give them the ability to go forward. The other part that can happen is that potentially, if there's money in just invested in the bank and it sort of depletes over time, one of the parents die or whatever, the remaining one is not necessarily left with a whole lot of choices.
Yeah.
So a continuing amount of cash flow, whatever it is, just flowing through, gives people the ability to continue to remain independent, to have choices, to not be reliant on the kids. It has so many ongoing benefits in terms of how that makes them feel and their mental health. So, a simple one purchase has the ability to fulfill all these different aspects regardless of what stage the business and the partners are in.
Do you find most people get succession right or they typically get it wrong?
I think everyone, I think there'll be a range. The thing that would make succession plans not follow through to successful settlement is a lack of money to fund it. And so if there's, so I think sometimes if the kids potentially get frustrated with why aren't mum and dad retiring and leaving us alone, well, maybe it's because there's just mum and dad are very aware that there's not a lot of money in the system for them to take and retire. So they, rather than admit that, they probably feel like they should stay around. And it sort of frustrates everyone, frustrates the parents, frustrates the kids. So I think everyone has their best intentions. I think the important thing to note is that everyone is trying the best with the tools they have available. And that's what we're sort of trying to do, is to say, look, there is this other tool available as well you may not have considered. We'd love to have a chat with you about it.
Yeah.
And I think in all business, doesn't matter if it's a rural business, but any sort of generational business, I think mum and dad would love to set something up for the kids if they chose to follow in that path. But if not, having an asset outside the business that's growing in value and providing options for everyone is always going to be a positive move.
It's all about those options, and it gives choice in the future because you don't know how it's going to. You don't know how it's going to fall.
No.
You say you are a farming family and you're part of your own succession story, and you've got the family farm, whatever that looks like, and you're getting married. Like, the time to start thinking about this is then you don't know how many kids you're going to have, or you're going to have any kids, but it largely becomes irrelevant if you get started because you get that choice, and in time you might liquidate the farming asset and you've already got assets outside of it, commercial property, for example. So you got to do this faster. You got to do it quicker. If you're 65 and you start thinking about it, you probably missed the boat, right? That's when you don't have time.
At least it's going to provide cash flow.
Yeah.
So at least you're keeping up with the value of money.
Yeah. There's a lot of farmers just keep cash in a bank getting 2% interest on it.
I doubt it.
Yeah. They use it, right? If they got it, they use it.
It's very asset rich, cash poor.
Yeah.
And as I said, in order to stay competitive, you need to continually be investing back into the business, whether it's storage for grain, whether it's, different things with livestock, or it's the, autonomous tractors.
It's a capital intensive business, right?
Yeah.
But the asset keeps going up in value, particularly if it's an attractive asset.
And the thing is, it's peculiar to a lot of other businesses in that it has a fair chunk of equity that can be utilised, and I guess it's sitting there as unutilised equity often. And so there is this opportunity that I believe is peculiar to these farming families, that they have the opportunity to just utilise the equity and therefore not really put any cash flow stress on the business. What's currently available to people when they go to retire is that the business may have to borrow money to buy mum and dad out. They may have to sell some of it, part of it. None of that is good for the key thing of maintaining the
So
the
what you're
size
saying is
and the
potentially
efficiencies.
sort of avoidable if you get your stuff sorted out early on and start creating assets outside of the fundamental business, which is some sort of farming activity.
Yeah. And the thing is, people, know that and potentially have considered it. I don't think It's widely recognized. I don't think people really understand what commercial property is. But the other big thing is, how do you start? You go, that's all great, but how do I, what have I got to do? And so you then kind of ignore it. You just put it on the back burner.
Well, I guess it starts with, you need a chunk of cash to either have a deposit or buy an asset out completely, right? That's where it's got to start. So how do you get that original dough together?
Well, you can just utilise the equity.
Yeah, so you got to refinance or sell something.
Well, they don't really even need to refinance. You just say, at the moment I've got 70% equity in my farm. I'm only going to, I'll be at 65 if I'll give this 5%, this bit of equity across to getting this thing started. It's not going to have any impact on the rural business. Still got plenty of capacity to withstand the next, year or so drought. I guess you get 4-year droughts, it's all different. But, it's all about just seeing what position you're in at the moment. It's an easy step. You don't have to buy a massive one. You can start off reasonably small, but at the same time, at any stage, any progress is good, it doesn't matter what business it is. So it's never too late.
How are farmers, Scott, going with rising interest rates? I don't know the number, but how encumbered is sort of rural assets with finance against it? I imagine people would just keep feeding off it and they've got a big mortgage against it, even though they might have large asset values. Do you know?
Yeah, look, one of the reasons, Michael's here as well. He was a client. Then we've worked with rural clients for years, and the cash flow issue was the big problem. So as interest rates have gone up, we've seen that problem worsen for a lot of them. So
on their residential rural property.
Yeah, Mike said, they might have a unit down on the coast somewhere, or they've got some other asset classes. But the fact is, commercial property will give you better cash flow than any other asset class. Yeah. So there's actually a lot more of them. It's almost like in the pipeline. They're just preparing, they're going through refinances. They need slightly higher yields on the commercial purchase because you can lease stock that, use the income from the future purchase to then fund the loan. And but the one thing that I've noticed with rural clients over the years is they are the best long-term planners out there because they've got to deal with droughts. Remember, there was a 10-year drought not long ago, and then there was floods and then bushfires. So these guys have weathered storms that the everyday city guy is not even capable of doing it unless you're a rare breed. So they've got the equity, they've got the mental strength to buy this stuff, and they buy it for the kids. That's why they're not buying it for look at my cash flow for the next year or two. I'm going to use that to go to Vegas or that. These guys are thinking for the kids.
Well, they're sort of been brought up in the same generational mindset.
Yep.
Fourth, fifth generation farmers. There's sort of this rite of passage, right? And there's responsibility that you got to prepare for the next generation. And I guess you want to be able to hand over the reins of the family assets in a better shape than what you've received it, rather than being that person that had to sell the family farm because they ran out of money, right?
Yeah, and look, it's very similar to any business. You run a business, you probably want your kids to be part of it somehow. So the difference with rural is, like Mike said, they've got so much equity. So obviously a business will have its valuation, a multiple of its income. But rural has a hectare rate, and they're literally seeing these things triple in value over the last decade in some areas. So they've had massive equity growth over large asset bases, and a lot of them don't know what they've got other than trying to expand the farm, and that's why Mike's here to kind of re-educate, because there is a chance to create another business on the side, and that's how commercial property is. Well,
it's an obvious diversification, right? You don't want to diversify into more farming ventures. You're probably worthwhile getting your money out of it into something else, which doesn't have the same headwinds and or tailwinds as what farming does.
And the types of properties they buy, I remember I had one of the guys that grew the most mangoes in northern Queensland. He ended up buying his local shopping centre. It was a big, cool 30-tenant thing. Had they love shopping centres because, you come into town and you just resonate with it. It's an easy to understand asset class, that one. Industrial's obviously the big growth headline grabber at the moment. Everyone's starting to go, look, let's buy industrial because the growth rates on the rent are so good. So that's entering the general knowledge sphere now, which 5 years ago, no one wanted it. So, those are the two main asset classes these farmers get because they can relate to it. And like Mike said as well, a tenant that's in manufacturing or storing of product, you might buy a big refrigeration or cold storage business that stores similar products to what they grow. you understand the contract side of things as well. So,
So some people do was a vertical integrator, right? So if you're in a business of mangoes, I imagine you've got to put that in cold storage for a period of time before you ship them off to market. So, so sort of supply chain orientated stuff.
Exactly. So you can go all the way down the line to the consumer. And then you deal with the logistics side of things on the warehouse side, and obviously the supermarket at the other end. So, and these require large amounts of equity, these types of purchases, and not many individuals have that. But if you're lucky enough to be a fifth generation farmer, then you're probably sitting on a pretty big payload.
And it's a sort of a light bulb moment for a lot of these farmers when you go, you can use all of this to do this over here and it's not really going to impact you too much. Yeah. Do they get it?
Yeah, well, it's a pretty easy cash flow equation. Like you just work off 100% debt. If they're getting a 6% mortgage right now, then, let's go look for a 7.5% asset, and obviously the interest rate will probably change a fair bit in the next 12 months, up and then down, or who knows, sideways. But rents are growing quite quick. So the gap between the interest rate and the mortgage should widen naturally over time. Some of the properties I bought a few years ago are sitting at 11%, just because I haven't refinanced them and the rent's gone up. So based on the original purchase price, they're returns I couldn't get in today's market. But time is your friend, and a farmer who's, got to keep 10 years of cash flow or 5 years of cash flow and then factor in all the maintenance and replacement of capital, basically their business is extremely tricky to manage. So property is a naturally easy thing for them to understand. And most business owners find commercial fairly easy. They're the guys that were investing in commercial property well before the mums and dads saw it as an asset class, because they would just see their factory, outgoings and go, I'm paying all this rent. I may as well acquire the shed myself and pay myself. And owner-occupiers dominated the space back in the day. But now we're seeing a lot more investors enter the market, and that's been the real big trend of the last decade.
Well, hopefully it's resonated, because it seems to make a lot of sense, Michael. I know you sort of come from a farming background and you've walked in these shoes, right? You know it pretty well.
Yeah. Yeah, and we've seen a lot of friends go different sort of journeys through it, and it's never easy for anyone. But I think what would make it easy is having this previously in place, or some positive cash flow asset out to the side that just gives another choice, gives another opportunity. And as all these things just give freedom. And the other thing is, people know this stuff's happening. It doesn't matter what business you're in. When you're neck deep in a business, it's hard to look outside and how do I get these things started, But really there is a pretty simple pathway. I think farmers are so well aligned with commercial property, it wouldn't be a big leap for them to either understand or to be comfortable with. And look, it's one of the reasons I like commercial property is it's a numbers game. It's purely based on the numbers. So you're not got anyone trying to sell you some dream of some, resi goes up and down on the back of I don't know what. Whereas commercials, just a numbers, it's a calculation on the net yield, and the net yield is a function of square metre rate and the quality of property and the tenants. So it's got the same fundamental things they'd look for in farming land: a good location, good productivity. It's a good long-term asset. It's a real asset, so they can actually, it's something that's not sitting out there in the sky. So, it's not a big leap, I wouldn't have thought. But again, there's got to be a pathway to get into it. And I think that's where Rethink, provides that pathway to, in the first case, just get comfortable with the asset, and then over time be able to step into it if they choose to go to the next step. But
So for all those guys and girls out there sitting on a combine harvester somewhere, listening to this on the Bluetooth connectivity which you have these days, what do you do? Like, you go, okay, well that sort of makes sense. I want to think a bit more about that. What do they just call you guys up and say, hey, I'm a farmer, I want to invest in commercial property?
Yeah, well, look, yeah, they do. And we always sort of try to push them towards talking to a broker to start.
Very good broker first to see what their capacity is.
Yeah, look, it's you can do it in the same time. You're hand-in-hand type situation. But and interesting, a lot of rural brokers, because there's obviously guys that specialise in agriculture, finance, and a land valuations and all that. So they're actually starting to push their clients this direction too. So that's due to cash flow again, and the brokers want to do loans and the people want to buy stuff, and the land values, it's pretty hard to stomach for a lot of them as well. They're used to the prices 5 years ago, and you hear what the neighbour's selling for, and they try buy it with the broker, and then someone outbids them by a lot, and it's almost like a second option a lot of the time, and it's important to have that broker conversation, because like Mike said,
it's all interconnected, right?
Yeah,
you can't do one without the other,
and you need the deposit first. So if you've got a $40 million property and it's got no income from it, and you've got no ability to get anything out of it, then you might have to sell a portion of it. So there's a bit of a planning stage that needs to go into it, and obviously Mike's an expert with that on the agriculture side. And then, basically the next step is, once you know your budget, let's go get the best dollar for dollar deal you can. So rather than just go spend it on 5 little assets around the country, that's almost like the stock standard residential buyer's agent approach, buy lots of little deals all the time. And you need to do that to a degree, because the yields get terrible as you go into higher prices for residential, but commercial, you get more income the more you spend. So you can end up only just doing 1 or 2 really good deals, and there's going to be a lot of safety and security off the quality of that deal as well. It's pretty easy from once they got the deposit. It's just understand the asset class, and that's obviously our job. Explain it to them, show them a few other deals, let the trial and error process play out.
And work it out. Well, it sounds like you really enjoy doing what you're doing, Michael.
Yeah, I love it. I'm really passionate about commercial property, and over time, it just sort of it became this obvious next move for me. But also, I thought about my friends and people I knew who had struggled with these things and have it coming up, and thought, this would really be a terrific solution for those guys. And that's really, Scott and I had some discussions over a couple of years, and that's what really attracted me to coming on board with Rethink, was because, it just makes you, if you can see someone make progress like that and solve a solution that is a difficult process for everyone, I think it's a pretty good feeling. So, yeah, I think there's so much potential in it.
Well, you get this right. You think about a lot of the friction it removes from family dynamics around the big succession thing. Like, you can ameliorate a lot of that at the front end if you get this right. And I know you fly your own plane, so you've flown all over Queensland, sort of visiting rural farmers. Anyone with an airstrip, you could land there and have a yarn to them. Maybe
you could
it's the flying. The flying property strategist. You see, you got the plane branded up yet? They know you're in town.
No. For a slow key.
It's really cool. It's a really good discussion, and I think for those people who live and habitate the cities, they often forget the importance and the integral role that farmers play in terms of national resilience and the ongoing economic growth of Australia. And it's been very much the story of Australia, and will be the story of Australia for many years to come. The great work that our farmers do, and our appreciation absolutely to them. But you don't need to sit around and wait for the death of the parent or someone getting to old age if you're in a farming family to actually having smart conversations around succession planning and building out asset classes and asset bases outside of the actual agricultural activity that you participate in. And my thoughts would be that the sooner you start at it, the better off the outcome's going to be and the more choice you're going to have over time. And no doubt you find people get really excited about this once they get going with it, and it probably ends up being their primary investment vehicle and transitions over. But thanks for coming in today. Thanks for coming down from Gundawindi.
Yep.
Go and Google that, everyone. You can work out remind you just how big Australia is. What's the biggest day on the calendar out in Gundawindi? Do you have like a race day or something?
Yeah, the Gundawindi races are pretty big.
Races.
Yeah, there's a few. Gundawindi races are big. For the younger people, the Gundawindi BNS is one of the last.
You do a BNS.
BNS
I did a BNS.
Going.
I did a Gunnedah BNS ball.
Yeah.
Yeah, I love a BNS.
Yeah.
But Scott, we're going to do that. I reckon we're going to go to the Gundawindi races.
Yeah. Let's go.
Let's do it.
Take his private plane.
I'll get a tent. I'll get a tent next year.
Yeah. Can you get a tent for the Gundawindi?
Do like a hospitality.
Yeah, all right. I reckon you guys have got to do all your rural clients. You invite them over to the Gundawindi. Like for rural people, you go, it's 500 k's away. It's just down the road. Yeah, no worries. All right, Gundawindi races it is.
Up there too. Catch up.
If people want to have a chat with Michael, Scott, what's the best way? Just info@rethinkinvesting.com.au. And just mention
where you're from as well. Like if you're from the rural side of things, there is a resource here that is a massive advantage, I think. Like there's no one in Australia doing what Michael's doing. And I think it's invaluable for him. And even if it's just for a chat about, the potential, and you may not do it for a 5-year period. Again, farmers are long-term planners, slow movers generally. I've had meetings with clients 5 years ago that signed up last year, 4-year wait. So it's all.
And I know farmers like a good yarn. You're just happy to have a chat with people that got any problems or concerns. They're happy to confide in you and what's going on and how you can find a solution for them.
Yeah, everyone's got an interesting story, so it's always good to have a chat. And, and it's the same applies to any generational business. The same issues exist and the same solutions. So the team's always there, and more than happy to have a discussion. And just a general yarn is often what people want in the beginning, just to open the door.
Well, it's going to start conversations, right? When you're sitting around for your Sunday dinner as a family, you can start talking about succession in a positive way. And I imagine that's the best outcome when succession is open, planned in an environment which is conducive to outcomes rather than the negatives of succession, which I'm sure happens. But go and get in touch with the team over at Rethink Investing. It's a really good story. I'd like to chat with some rural clients if you can find them and get stuck into it. That'd be really good. How they've made that transition and change, rethinkinvesting.com.au. You can check it out there. That's Scott O'Neill and Michael McIntosh for Rethink Investing. We'll get them back again soon. Hope you enjoyed that, everyone. There's lots of other episodes. Very different, this one, Scott, from what we normally would do. And you see the expansiveness of this discussion, this dialogue that myself and Scott are having around commercial property. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.